For the love and all that is good, do not pay this tax. Do not pay this tax. I'll do this every year I have this YouTube channel. It is the stupidest tax to pay. So Vanguard just published their preliminary capital gain estimates, and we're going to dive into that here in just a second. And just like last year, the capital gain distribution estimates are quite large, that's for sure. And the reason because of that is we haven't had a bear market of any significance for any extended period of time for going on 11 years now. And so they have this huge capital gain distributions, because make sure my little tax credit, well, he's not even tax credit. You can't take a tax credit for dogs, can you? Anyway, they got these huge, not just Vanguard, all firms do, you probably do in your holdings of capital gains, unrealized capital gains. The problem is when a mutual fund has an unrealized capital gain, it makes it realized, it must send the distribution to you, so thus you have to pay tax on it. So let me, as I do every year, I'll share this story. I had a lady. She had American Century funds. I'll never forget this. In 2014, maybe, she came to my office, pissed as the day is long, threw down her American Century mutual funds. And I didn't sell it. I had nothing to do with it. I mean, but she had it, and she had it at a USAA account. And I think she had bought it from a broker that transferred into USAA. Comes to my office here now, Alfreda, slams it down. You know, she had like $100,000 or $200,000 or something. I think it was $200,000 in American Century. And she had a $40,000 taxable distribution. If I take my trusty old calculator and I say 40,000 divided by 200,000, that is a 20% capital gain distribution. 20%. She did not sell the shares. She just had them, sat on them. She had literally, I think it was like Social Security, they're holding the other income. I can't remember, but I just remember maybe a $5,000 RMD. Now, this is a non-IRA account, so she had to pay income tax on that $40,000 of distributions. Now, it was long-term capital gains to some degree, ordinary income to some degree. It was short-term capital gains, and it was qualified. I can't remember the whole story, but she had a $40,000 distribution, which meant her Social Security was taxed, and I think she had it, I can't remember, but I remember she had to pay tax on it. She did not have the money in which to pay. She was pissed. I love that dog by East Tags. All right, so anyway, let's read up on this here because you need to know this. There we go. So I'm going to show you just a couple ones. These are preliminary stock and balance funds distributions. All right, so what happens here? Actually, let me see if they say it on here. Mutual funds and ETFs typically distribute taxable capital gains to shareholders each year. Below is a list of Vanguard funds that were expected as of the end of October to distribute taxable capital gains. And you know most of these are actively managed, by the way. To estimate the distribution for a fund on this list, multiply the fund's total per share capital gains estimate by the number of shares your client owns. Estimates are subject to change. Funds not listed do not expect, as of October 31st, to distribute a capital gain in December. What are you chomping on there, Chompy? All right, so they don't say anything about buying the dividend. So we'll go into that here in just a second, or the distribution. All right, so whoever owns will use the Capital Opportunity Fund. Whoever owns the Capital Opportunity Fund as of 16 December 2019 will get the distribution. So that's a date of declaration. This is the date in which the price goes down by the amount that they pay. All right, and I'll get into all this here in just a second. And this is when it's paid. So if you own this as of 12/16/19, you will get this distribution of $8.87 per share. All right. The next day, the price of the Capital Opportunity Fund will drop by this amount right there. Again, this is estimate. Will drop. We know this for a fact. It will drop by $8.87. And the next day after that, you will get $8.87 per share you own. So for simplicity, let's just say we're not even going to use number of shares. We're just going to say you have $100,000 in the Capital Opportunity Admiral Fund. You're going to get 5.58% of the entirety of that $100,000. You'll get $5,580 as a distribution. I would imagine the bulk would be long-term capital gains, but still, it's almost $6,000 of distributions, of capital gain distributions, all right? That's not what we want. We don't want that. Now, the biggest mistake you can do is called buy the dividend, which is you buy, if you were to pay $100,000 into this fund on 12/15, you are buying this $5,585 of capital gain distributions, which the very next day it will be taxable to you as capital gain. Does that make sense? So what happens here? You're going to buy $100,000 of capital opportunity fund on 12/15. I'm just using that for example. The next day you are the owner of record on 12/16. The next day it drops by $5,580 because of that dividend. Now, if you reinvest the dividends, you're back. You have $100,000 in there. If you take the dividends as cash, you have $94,500 in there roughly. So you're still even in terms of your total asset. You still have either the cash on the side or you have the dividend reinvested in the asset. The share price drops, but it doesn't matter to you because the share price dropped by the amount of the dividend that you paid. So you're even Steven from that perspective. You had $100,000, you still have $100,000. You had $100,000 in the fund, now you have $94,000, but you have $6,000 of cash. You still have $100,000. But that $6,000, roughly $5,500 of distribution is taxable to you. You see what I'm saying? So if it's a non-IRA account, you still have $100,000, but depending on what your tax bracket is, you will have 15 or 20 or 23.8% less, depending on what kind of income it is, the long-term capital gain. So you'll have to pay, we'll just say 20% on that $5,500 of dividends of a capital gain distribution, minus 20%. So you will net $4,400. So you are down literally $1,100. So you start with $100,000. You got a dividend distribution, in this case, capital gain distribution. Same thing with dividends. We'll just say $5,500. All right, you reinvest it, so you still got $100,000 in there, but you got to pay tax on it. So you're going to lose in a 20% tax bracket $1,100. So now you're sitting on $98,900. So because you bought this share on the day of declaration, on the day before declaration, you're going to have a taxable gain to you of whatever this amount is right here, 5.5% of the entirety of the portfolio. So you're going to have that as a taxable gain. So you're going to be sitting with not $100,000, but you'll be sitting with $98,900. Hope this makes sense. Now, if it's an IRA or Roth, it won't matter. It won't matter because those you don't pay tax on that until you pull the money out. Anyway, so let's keep looking. So we got what's the one I own? The dividend growth fund right here. So dividend growth is going to pay 95 cents per share as a dividend. Let's say I own 100 shares, so I know I'm going to get, if I have 100 shares, I have literally no idea what the share price is. It doesn't matter. If I own 100 shares, I'm going to get 95 cents per share. That means I'm going to get $95 as a capital gain distribution, which I have to pay tax on because I have the DDIGX. I have that in my IRA actually, so that won't matter for me. But if you didn't have it in your IRA, it would. But here's a big one right here. Diversified equity is going to pay 6.71% of your entirety of your holding will be taxable as capital gain distribution. What's the one I have? Small cap index, I don't think it'll be on there. I don't think any of the index funds are really. Yeah, so prime cap, look at this. Mid cap growth, whoa. 11% of the NAV. If you have $100,000 in mid cap growth, you're going to get a capital gain distribution of $11,000. Whoa. Again, it doesn't really matter. It does matter because it's taxable to you, which is why we want non-capital gain distributions and non-dividend distributions in a taxable account, all this stuff in an IRA or Roth. But in terms of the net asset value, it won't matter. You'll still be even Steven other than the taxes that you have to pay. I hope that makes sense. Yeah, so look at that, 8 on Windsor. Ooh, and I just read that the John Neff of Windsor Fund just died. So that was that's too bad. God bless him. Good guy, good manager of that fund. Windsor, 8%. Windsor, 2%. Yeesh, that's bad. That's big. So you notice there's no index funds in here. And the reason there's no index funds in here is simply because index funds, they don't have much turnover, and B, Vanguard has some kind of way they can, I don't know how they do it, but they don't have to send the capital gains. They have some kind of patent on how it works. I don't want to get into that right now. It's great. There's 6.82 in the healthcare. Yeah. So those are the ones to be careful of right there. I might actually do a blog on that. It's Windsor 2, Windsor. Yep. Let's see. Bonds. Bonds shouldn't be a big deal because not much in capital gains and bonds. You got the global. Yeah. Just foreign bonds are. There's a little bit of capital gain, not much. let's see, yeah, bonds not much. So that's not anything to concern yourself with because there's really no capital gains on bonds. But anyway, a dumb tax to pay, my friends. Don't do that if you can avoid it. You don't want to buy the dividend. That's just, I don't know if, let me see if Vanguard, they have the dividend. Let me pause for a second. I want to see if Vanguard has anything on the dividend distributions they have. Hold on a second. So this isn't going for us from March of 2009, but 2019, excuse me. But basically, this is where supplemental fund distributions that you have to pay tax on in 2019. Not much, and this doesn't tell us much. But anyway, just FYI. Here's percent of NAV healthcare. There you go. Again, healthcare had a significant dividend distribution. That's capital gains. Supplemental fund distribution. That's not even dividends. Yeah, so I'm not sure about the dividends, but look at that. That's, man, healthcare. Woo! That's 4.15. That's in March. Man, look at that. That's crazy. So healthcare 4.15. Then we go. What is it right here? Healthcare right here. Oh, 6.82. That's that's 11% distribution. That's, I don't even know, does healthcare even have dividend? Oops, hold on a second. Let's get out of this guy. Oops. Let me get out of this guy. Does healthcare fund even have dividends? Because that could be pretty. Vanguard. Oops. I can't remember the ticker. Healthcare fund. Let's see. Can you give me something here, man? Oh, okay, we got the ticker right here. VGHX. Say that 5 times fast. VGHX. VG. Right there. Okay, cool. Let's take a look at this guy. Man, that's 11%, almost 12% on capital gain distributions. Let's see what it's got for if there's any dividend yield here. This is tough to follow, isn't it? Man, just there's a portfolio right there. Review and perform. Okay. Ed Owens no longer runs it, huh? You can see how much I've been following this. Let's see. Did we got a? Let me pause this for a second. So basically, the last 30 days, it paid 1.3% dividend yield. As a price per share, as of 10/31, is basically 1.5% dividend yield. Man, look at that. Realized gains as of 10/31, 6.79. But then on top of that, we had the supplemental distributions from last March. So if you didn't own the fund, it doesn't matter. If you own the fund at the beginning of the year, you're getting hit with all that. Unrealized capital gain, 32.67. Man, that's nuts. All right, so we had an income, paid 5 cents a share on, what was that? On 329, 29 cents a share short-term capital gain, which was a record date 328. Long-term capital gain, 3.41. Man, there's a lot of distributions on this guy, man. Whew. Yeah, that's fine. I mean, because look at the performance; it's kicking butt, taking names. But if you aren't expecting, year to date as 11/15, if you weren't expecting to get hit with a lot of taxes, Vanguard Healthcare Fund would tell you otherwise. So, anyway, I saw some other stuff. I didn't realize they break it down pretty good here. I like that. So let's take a look. Annual return by NAV. So capital return 18.5 with dividend 1.22. Total return 19.6. So the capital appreciation of 18.5, 45, where the year before they had a negative appreciation. It fell by 9%. I just love these kind of the way they break these out, how they break it out in income, capital return, and income return. You can see the income return. That's their dividends right there, 1.8, 2.2, 1.97. Let's just see what else we got here. I wanted to look at something else. So you would have almost, quadrupled your money if you had it for 10 years? That's nuts, dude. I don't care about all right, so look, if someone's talking to you about beta, R squared, just get out of there. I mean, that's what guys try to do to justify their fees. Standard deviation, that's fine. Just means it's but even when they start talking, it doesn't matter. You're investing it for the growth. Sortino ratio, I don't even know what that is. I mean, I do, but I don't really care. All right, so I want to look at price to earnings and price to book, though. I think I saw that down here. Yeah, right here. PE ratio 23.7, price to book 3.5. So this is definitely more on the growth side of the equation. Earnings growth right there. Look, benchmark 5.5. Who else is saying benchmark 5.5? Your buddy Josh. We're saying 5.5% earnings growth year over year plus a 2% dividend yield, or you can say 5% earnings growth year over year plus a 2.5% dividend yield. That gives you 7.5. So the healthcare is growing at 9.6%. That's fantastic. With another, almost a 2% dividend yield, there's your 11% rate of return. I like it. All right. The average rate of growth in the earnings over the past 5 years of stocks in the portfolio. There you go. Actually, let's while we're doing this, going on a tangent, aren't I not? So let's go to VFINX. All right, that's just the S&P 500. I want to see what their earnings growth year over year is. I love these sparkling ice waters, cranberry frost. Oh man. Then they got these ginger lime ones. Woo, that's good. All right. So let's just see. I want to see the earnings growth year over year for the S&P 500. Let's see here. Hold on just a second. Don't care about any of that crap. Let's look at the price to earnings ratios. Shall we? Shall we? Yes, we shall. Why? Because I'm in charge. All right, so we got earnings growth. Look at that, 10.4% earnings growth year over year for the last 5 years. That's interesting to me. So we've been way undervaluating earnings growth year over year for forward projections. Should we change that? Man, I don't think so. Earnings growth year over year. That's interesting. PE ratio 21.2. That's high, but that's not. That's not extraordinarily high. Like, we need a bubble. We're in a bubble. What's the returns been over the last 5 years? Let's take a look how they break it down for returns. Cumulative returns 5 years. That's cumulative. I don't want that. So earnings growth 2008, 18, a lost capital return. 19, yeah. So last 1, 2, 3, 4, 5. So if we go to, let's start with we're going to do like this. 100 times 1.1146 times, what's that? That'd be 0.926 times 1.096 times 1.1948 times 0.9377. 0.9377. So the earnings growth has gone from 100 to 126 over the last 5 years on an annual, not a cumulative, on an annual. I mean, that'd be is that? I don't know what that is. That's compounding. That's what I meant to say. And the income distribution, about 2. That's interesting. I mean, but see, that's not earnings growth. That's capital returns. The capital. Actually, the earnings growth has been significantly higher than capital return. What do we make of that? The earnings growth has been significantly higher than capital return. That is interesting to me. I mean, look at but see, then you got that right there, 29, 13. That is, does it give us earnings growth over the last 10? It's only 5 years. I'm talking about something I realize, but this is just, I'm using the noise in my head to try to explain something to me. Yeah, past 5 years. So the earnings growth has been significantly higher than the capital return. Again, capital return is just price appreciation or depreciation. The capital return, that's what that was. The capital return compounded at 126. So I mean, if you had $100 in there at the begin of 2014, you'd have $126 in there today, which doesn't seem all that impressive, frankly. Well, the earnings growth is going at 10. how can you sit there and say we're in a bubble? I just don't get it. Anyway, what I like, going back to taxes, what I like about the index funds is there are no tax. I mean, there's going to be some distributions on dividends, but no capital gain because of the patent Vanguard has. Let's just look at VTV. I don't know what they do ETFs here. Yeah, let's see. This is what I own. I own VTV and VDIGX. But if earnings growth is significantly higher than capital return, that tells me there's significant upside for capital return. VTV is up 22% this year. Freaking crazy. Let's see what this guy's doing. Man, that's nuts. 22%, my friends. Let's see. I'm just sitting there thinking, I mean, you're not, the real estate guys, I get it, but my goodness, you're up 22% in a passively managed portfolio of you don't have to do anything. Just sit on your hands and look out the window when the markets go south. All right, so capital return, 10. I mean, I'm just going to, for simplicity, I'm not compounding this. 7, 20, 35, 28. So the capital return is 28% over the last 5 years. The dividend yield is roughly 2.5. So 5, 10, 12 and a half. So 20. So basically, that's a 40% return over the last 5 years from dividend. I'm just doing adding. It's simple, not doing compounding. But basically, that's a 40% return over the last 5 years from capital return and dividend yield. And let's see what the earnings growth has been. Let's see, where was that? All right, only 4.2. Huh. 4.2 on the earnings growth for the value stocks. So this portfolio has outperformed its earnings growth year over year. 4.2% for the last 5 years with a 2.5% roughly dividend yield. Huh. That means the capital appreciation has beaten the earnings growth. Why do they keep sitting there? Man, that's interesting to me. Where'd it go? Right here. That's interesting. Now, if you looked at PE ratio and you look at price to book, let's see. Let's keep going down. PE ratio is 17. Price to book's 2. Let's look at VUG. Let's just, I know I'm way off my initial thoughts on this. I can look at this stuff all day long. I mean, it's nuts. As if it's going to mean anything. It doesn't. But I sit there and think, if the earnings growth has been that significantly high on growth stocks and has dominated its actual return, its capital return, and there's not much of a dividend to speak of. Man, so that means we have to think that the earnings growth on the value is going to turn around. Because this is hindsight. And then the PE ratio is much, much lower. Was it 17 on the VTV? With a price to book of 2.2? Let's take a look. And look, this one's up 31.57 this year. That's insane. That's insane returns. Insanely good. I hope you've been in there. Capital return, 1, 2, 3, 4, 12. Let's say 14, 18. Was that 18, 28, 38, 44? So 40%, and then the income returns about half that of the value. So we'll just say 45% returns. And again, I'm just in my head thinking this out loud here. Don't kill me here. But then if we go to earnings growth, I bet it's freaking crushing it. I bet it's crushing it. Yeah, 17.4. Look at that. That's annual, right? Yeah, average annual growth rate. So they're at 40%, 44% on capital return and dividends, but the earnings growth rate is crushing it. PE ratio is high. That's what scares me. PE book is, over twice out of the VTV. I don't know. That's nuts. Yeah, that's nuts. I don't know what to, man. Let me just look up one other thing. VIDGX. Let's look at, because I own this one too. I own three. I own VTV, VDIGX, and then the VBK, which is small cap growth. Five years is average 11.75. Capital return, look, not much. Let's say 15, 20, 30. About 2%. So that's 2, 4, 6, 8, 10. So about 10. So 40% with dividends and earnings growth and capital appreciation. Yeah, but the earnings growth here is low, actually. Oh, yeah, 4%. Still high PE ratio, high PE price to book. What to make of that? Earnings growth has killing it on the growth side of the equation. Earnings growth has not killed it on the value side of the equation. What to make of that? Huh. I just don't know. Because earnings growth is what dictates returns. And see, this is the thing. This is hindsight. Does that mean the value side of the equation is going to have big earnings growth going forward? That's what I'm gambling on, man. But to be honest with you, I'll take that gamble. I'm still getting 20% rates of return. I'm still going to take that. All right. Anyway, this is a rambling thing, but that's interesting to me. Just don't buy the dividend. Don't buy the capital gain. All right. We'll see you.